Today we are looking at Taiwan Semiconductor, ticker TSM. This might be the most important company behind the AI boom, because so many of the leading AI chips depend on TSMC manufacturing. But the stock question is not just whether the business is excellent, the question is whether the price still gives enough margin of safety. The simple thesis is this: AI backbone, not automatic bargain. By the end, you'll know my fair value range, the buy zone where I would get more interested, and the three numbers that decide whether this thesis keeps improving. Those numbers are Q1 revenue of $35.9 billion, gross margin of 66.2%, and the Q2 guide of $39 to $40.2 billion. This is not financial advice. I'm using the numbers for education and research. If you enjoy plain English stock analysis that separates real opportunities from value traps, subscribe to FinanceToGo and let me know which ticker I should cover next. TSMC is not a normal semiconductor company. It is the foundry that manufactures leading-edge chips for many of the strongest technology platforms in the world. That includes AI accelerators, high-performance computing, smartphones, and advanced packaging. The reason investors care is simple. If AI demand keeps growing, capacity at the leading edge matters. TSMC sits in the middle of that demand. That gives the company scale, pricing power, and a strong moat. The catch is that the business is capital intensive, exposed to semiconductor cycles, and carries geopolitical risk that cannot be ignored. The latest quarter was strong. Revenue reached $35.9 billion, up 40.6% in US dollar terms. Gross margin was 66.2%. Operating margin was 58.1%, and net income grew 58.3% year over year. That is a clean AI demand quarter. What improved is clear. Revenue growth was strong, margins were elite, advanced nodes stayed dominant, and management guided for another step up in Q2. The caution is that expectations are now high. Heavy capex, inventory built during the N2 ramp, customer concentration, and geopolitics all still matter. So the quarter supports the bull case, but it also raises the bar. When a stock already trades at premium, good numbers are expected. The next section matters because we need to separate business quality from stock price. My overall FinanceToGo score is 8.1 out of 10. Growth score is high because AI and high-performance computing demand are still pushing the business forward. Profitability is even stronger because very few companies can show this level of margin at this scale. The lower scores are valuation and risk. Valuation is not broken, but it is not cheap either. Risk is also real because TSMC combines semiconductor cyclicality, heavy capital spending, customer concentration, and Taiwan geopolitical exposure. Bulls may be right about the business quality, but they should not treat those risks as like they disappeared. The price chart tells us the market already understands the AI story. This is not forgotten company trading like nobody knows what it owns. The stock has been rewarded for being central to AI infrastructure. That does not make it a bad stock, it means the entry point matters. For me, TSM is a quality research list stock, but I do not want to confuse a great business with an automatic bargain. My fair value range is roughly $360 to $430. The buy zone is lower, around below $34 to $360, because I want some margin of safety for the risks. I'm not trying to get the exact value down to the penny, I'm trying to see whether the current price gives enough upside for the risk. In the bear case, if margins normalize, AI demand slows, or the risk discount rises, the valuation could fall towards $280 to $340. In the base case, TSMC remains a premium compounder and sits around $360 to $430. In the bull case, if AI demand stays exceptional and margins hold, the upside can move above $460. That puts the stock in a fair to premium discussion, not a screaming bargain zone. The bull case is powerful. TSMC is the bottleneck supplier for leading-edge AI compute. Margins show real pricing power. N2 and advanced packaging can extend the leadership cycle. And while customer concentration is a risk, the customers are some of the strongest AI and compute platforms in the world. What bears may be missing is that this is not just an AI storage stock. The proof is already visible in revenue growth, margins, and guidance. If those numbers keep holding, TSMC can deserve a premium valuation. The bear case is not that TSMC is low quality. The bear case is that the stock may already price in near perfect AI demand. CapEx is huge. Free cash flow has to be judged through the cycle. Geopolitical risk is structurally higher than for most chip companies. And if a few major AI customers slow their roadmaps, the story can change quickly. What bulls may be underestimating is the risk of paying a premium multiple for peak excitement. The main thesis breaker for me would be margins falling below the mid-60s without a clear temporary reason, or guidance dropping below the high growth path. My FinanceToGo verdict is buy, but not cheap. TSMC is good enough to keep on the research list, and the business quality supports a positive rating. But I would reserve a stronger rating for a cleaner margin of safety closer to the buy zone. The thesis improves if Q2 revenue lands inside or above guidance, gross margin stays around the mid-60s, advanced node demand remains strong, and free cash flow holds up after CapEx. The thesis weakens if guidance rolls over, margins drop, customer demand slows, or geopolitical risk starts affecting capacity plans. The real investing lesson is simple. A world-class business can still require price discipline. Great company and great stock are not always the same thing. If you want more stock breakdowns like this, subscribe to FinanceToGo and comment below. Is TSMC worth researching at this premium price, or would you wait for the 340 to 360 buy zone? Again, this is educational content only, not financial advice.